What if you could read market structure perfectly, follow every smart money concept by the book, and still get stopped out twice on the exact same chart that was about to hand someone else a clean, profitable trade? That is not bad luck, and it is not a broken strategy. It happens to disciplined traders every single day, and almost none of them ever find out why. In this video, I am going to show you exactly why, and then take that same 15-minute Euro USD chart, the one that cost you 2 stop losses, and turn it into a winning short. Not a single candle on that chart will change. The only thing we add is the one piece of context that separates traders who are right from traders who are right at the right time. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Trader, see if this situation has ever happened to you. You open the 15-minute Euro USD chart, and the market seems to hand you a clean, bullish scenario. Price is forming higher highs and higher lows, repeatedly breaking structure to the upside. Everything you have learned about market structure tells you that buyers are in control. You identify the most recent bullish move and use the Fibonacci tool to define your trading range. The plan looks simple and logical. If price breaks above the previous high, you enter a long, place your stop loss below the most recent higher low, and target a 1 to 2 risk-to-reward ratio. Price breaks the high. Your order is triggered, and for a moment, the trade seems to confirm your analysis. But shortly afterward, the market reverses sharply, moves lower, and hits your stop loss. Notice what just happened there. The chart gave you exactly the picture you were hoping to see, and the moment it did, you stopped looking for anything that might contradict it. That is narrow framing at work, trusting one tidy story because it is convenient, not because it is complete. So you go back and review the chart, and you realize what you missed. The higher low your stop loss was sitting under was not a protected low at all. It was exactly where the inducement was, resting right on top of a fair value gap, which means the move that stopped you out was simply the inducement being taken. So the real mistake was buying the breakout in the first place. What you should have done was wait for that inducement to be swept and for price to retrace into the fair value gap, possibly reaching the optimal trade entry zone. So even after taking that first stop loss, you don't abandon the idea. You re-enter, this time with the corrected plan, and you feel more prepared. Once the inducement is taken and price retraces into your entry area, you enter the long position, placing your stop loss below the most recent low and your target above the next higher high. Price begins moving in your favor. It continues higher and comes extremely close to reaching your take profit. At this point, everything seems to confirm that your new analysis was correct and that this trade is finally going to be a winner. But just before reaching the target, price suddenly reverses. It drops sharply, moves all the way back through your entry, and once again hits your stop loss. Now the situation becomes genuinely frustrating. You understood the market structure. You identified the inducement. You waited for the retracement into the fair value gap and the optimal entry zone. You followed every concept correctly, and yet the result was exactly the same. Here is the uncomfortable part. You did not break a single rule. You executed a textbook setup twice. The flaw was never in your execution. It was in your frame. The 15-minute chart told you a complete self-contained story, and a complete story is the most convincing kind, because nothing inside it warns you that a larger story may be running in the opposite direction. And that is the reason this happened. You analyzed the setup only from your entry time frame. You read the market structure perfectly on the 15-minute chart, but you never asked what the higher time frame was doing around it. That is why multi-time frame analysis is so important. Before looking for an entry, you first analyze the higher time frame to understand the market's broader structure, its direction, and its key areas of interest. Only then do you move down to your entry time frame and look for a setup that aligns with that larger context. In other words, the lower time frame may show you where to enter, but the higher time frame tells you whether that trade makes sense in the first place. Widening the frame is not extra work. It is the difference between reading a single sentence and reading the whole paragraph it belongs to. Same words on the screen, completely different meaning. Before we go further, one quick but important note. From here on, we are going to lean on several technical concepts, such as market structure, point of interest, the optimal trade entry zone, order blocks, inducement, fair value gaps, and so on. The goal of this video is not to teach each of these concepts from scratch. It is to show you how they come together inside one real situation, and why reading them from the right time frame changes everything. So if any of these terms is new to you, or you simply want a deeper understanding of one of them, do not worry. I have left links in the cards and in the description to our best videos, the ones that explain each concept in the clearest way possible, so you can dive into whichever one you need. For now, just keep your focus on the situation we are solving here, and let these ideas do their job together. Now let us return to the same chart and analyze the setup step by step. We will begin with the 4-hour chart to establish the broader market context and define the area that deserves our attention. From there, we will use the 15-minute chart to observe how price reacts inside that area and determine whether the opportunity is actually valid. The trade itself depends on a clear sequence. Price must first pull back into the higher time frame point of interest. Then, the lower time frame must confirm the expected direction with a change of character. Only after that confirmation do we look for an entry inside the optimal trade entry zone, with the stop loss beyond the most recent high and profits taken in 2 stages. Starting with the 4-hour Euro-USD chart, we can identify a clear bearish market structure. Price is forming lower highs and lower lows, while continuing to break structure to the downside, which tells us that sellers remain in control. Now, using the most recent bearish move, we apply the Fibonacci retracement tool to define the current trading range. Within that range, we identify the order block responsible for the most recent break of structure. As we can see, this order block is also positioned inside the optimal trade entry zone, creating a strong higher time frame area of interest. At this stage, our objective is not to enter the trade immediately. Instead, we wait for price to retrace back into the 4-hour order block. Only after price reaches this area will we move down to the 15-minute chart and begin looking for lower time frame confirmation. As the chart develops, price retraces into the 4-hour order block exactly as anticipated. Now that price is trading inside our higher time frame point of interest, we can shift to the 15-minute chart to refine the setup and look for a precise entry. In other words, the higher time frame has shown us where we want to trade. Now the lower time frame will help us determine when to enter. Before we continue with the chart, let us first define the strategy we are going to use on the 15-minute time frame. Because the 4-hour chart has established a bearish bias, we will wait for the 15-minute market structure to align with that direction. Our first confirmation will be a change of character to the downside, created when price breaks below the most recent higher low. Once price retraces into the optimal trade entry zone, we enter the short position. Our stop loss is placed one spread above the most recent high, and we use a 2-stage profit-taking strategy. The first take profit is set at a 1-to-1 risk-to-reward ratio. When price reaches this level, we close 50% of the position to secure partial profits. The remaining 50% of the trade is left open, with the final take profit set at a 1-to-3 risk-to-reward ratio. This approach allows us to lock in profits early, while still giving part of the position the opportunity to capture a larger move if the trend continues. Now we are looking at the same 15-minute chart from the first example, where our 2 previous long positions were stopped out. Nothing on the screen has actually changed. The same candles, the same higher highs and higher lows are still right there. What has changed is the frame we are reading them in. Instead of focusing only on the higher highs and higher lows visible on the 15-minute chart, we are now following the bearish bias established on the 4-hour chart. As price develops, it breaks below the most recent higher low, creating the change of character to the downside that we were waiting for. We then use the Fibonacci retracement tool to define the bearish trading range and identify the optimal trade entry zone. Price retraces into that zone and triggers our short position. With the stop loss placed above the most recent high and the take profit set at a 1-to-3 risk-to-reward ratio, price moves lower and reaches our profit target. And that is the entire lesson in a single image. The chart that cost you 2 stop losses and the chart that just paid you were the very same chart. Not a single candle was different. The only thing that changed was the size of the frame you judged it from. Think about what actually went wrong in that first example. You never analyzed the higher time frame. You read the 15-minute structure flawlessly, but you were reading it in isolation, so every higher high looked like strength, when the real story, one level up, was bearish. The moment you brought in the 4-hour chart, everything fell into place. It revealed the true market structure, it pointed you to a clear point of interest, and it put the direction of the trade on your side. Only then did you drop to the 15-minute chart, not to decide the trade, but simply to time it. So master your market structure, absolutely, but never trust a single time frame to tell you the whole story, because the market is always writing a larger one around it. Analyze the higher time frame first to find your bias and your point of interest. Then let your entry time frame confirm the moment. When both agree, you are no longer guessing which side to be on. You are standing on the side the bigger picture was pointing to all along. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.